Folks, it finally happened. Microsoft just acquired Activision. Now, what does that mean for investors like you or I looking to buy Microsoft? Well, in today's video, folks, we are going to uncover whether if Microsoft is over or undervalued. If you're new to the channel, my name is Leo. I'm a value investor, and I love finding companies, or sorry, rather great businesses at fair prices. That's a little asterisk if you want to know. So with that being said, folks, we're going to jump into Microsoft's profile, see what they're doing right, what they're doing wrong, and factor in, or to the best of our abilities, this whole acquisition, because it's still so very fresh, to figure out a fair value for Microsoft and if it's worth a buy right now. Let's jump into the software. So if you're new to the channel, this is the software I like to use. This is called StockSpec. It's loaded up Microsoft, and I look at 10 key things, folks, to make my investment process super easy and super easy to follow along. So with that being said, I have the financial evaluations loaded up here, and the score for Microsoft is currently a 9 out of 10. So what does that mean, folks? On a foundational basis, Microsoft is doing a lot of things right and one thing wrong, and that is their price earnings ratio on the 5-year average sitting at around 31.28. Now, what does that mean for us investors? Well, essentially, on average, you are essentially paying a premium based off their earnings if you just follow that one metric. However, there are 9 other metrics to take a look at, and in case you're wondering, the company would get a point if the price earnings ratio on average sits around 22.5 and lower. So 31, a little bit of a premium, but everything else is looking really good with Microsoft. The current ratio is sitting at 1.77. So if you don't know what that means, essentially they have enough assets on hand to cover their liabilities. It's something you really want to take a look at, considering the fact that, it's a high interest environment right now. Being able to cover your liabilities is always generally important in good business practice. The return on equity average is sitting at a whopping 39%. Ultimately, folks, a stable ROE is something you want to look out for, especially if it's over 15%. It being at 39, loving that. Their EPS growth over the last 5 years was 872%. An increase in EPS, always really good. Oh, here's the 1-2 punch combo, guys. Debt to equity sitting below 50%. Share dilution sitting below 1%. That is great. We love finding companies that are buying back shares and keeping the debt to equity low. Companies that are fueling themselves through equity, always a massive positive, especially in a high interest environment. Taking on debt, no bueno, folks. No bueno when the interest rates are high. When interest rates are lower, I don't care. But anything that's over 50%, I want to throw up. So I don't want to. That seeing 29%, loving that. Net income is up. The free cash flow is up. Return on invested capital sitting at 25%. That is massive. And the revenue growth is up by 14%. It might seem kind of low, but 14% for a $2.4 trillion company, guys. Like, take a look at this. Let's go on an annual basis here. $110 billion just in 2018. In less than 10 years, we've doubled our revenue. And now they've acquired Activision, a massive video game company that has great IPs such as Call of Duty, World of Warcraft, and let's not forget every mom's favorite game of all time, Candy Crush. That game is just bare money. Now, while Microsoft's revenue growth is impressive, and the fact that they were able to double the revenue in less than 10 years, we have to factor in Activision and what that brings to the table. Those 3 IPs bring in a ton of revenue to Activision, and ultimately Call of Duty is the moneymaker. But if I load up Activision's profile here, we can see on, let's say, the income statement on an annual basis, the revenue's been pretty consistent and pretty stable over the last 10 years. Now, ultimately, where do I stand with Microsoft? I think it's a phenomenal business. I think they're doing a lot of things right, and I can ignore that 31.28 average price earnings ratio. Now, going forward, how can we predict growth of this business? Now, that is where things get a little tricky because of the fact that it just happened, right? So we won't know until we see another a couple of quarters to try to get, or maybe even a year, to try to see what our footing might be for this company. However, what I like to do, and it kind of works into my favor because ultimately I'm a conservative investor, so I will try to make conservative revenue growth numbers for Microsoft, anticipating that they will potentially beat those revenue growth numbers. And if it works out for us, this makes it a better buy. So in order to do that, what I did was I loaded up the price analysis section here, and this part of the software essentially is your intrinsic value calculator, and I did 3 different estimates. And folks, if you're loving the channel, you're loving the video, hit that like button and the subscribe button. It means a lot to me, it means a lot to the channel, it helps out the channel a lot. But back to what I was saying is I've done some conservative revenue growth numbers being 5, 5.5, and 6. You can do 3 different estimates, and I'll show you what that looks like. So based off their 1 year, I kept it slightly below what they've done over the last year. And profit margin, I kept it in line of what they historically shown. Free cash flow margin, same thing. With a conservative price to free cash flow and a conservative price earnings ratio and a desired return of 13%. This is going off the fact that I think and I hope that they're able to beat these revenue growth numbers. If they're able to do that, then this will look great for us. I'm going to click calculate. The software is going to crunch all of these numbers here. The current price of the company is $328, which is quite a little bit of a dive from our 52-week high, sitting at $366. Average calculations comes out to be $169.34. Now, here's what I think, folks. I think personally, that price with Activision might be on the high side of $198, just because of what they bring to the table in terms of their IPs. That's the one thing that's going to obviously carry them forward. However, what would that look like if I did 6, 7, and 8? Now, if I click calculate, so keep that in mind, folks. Currently, it's at I want to say 168 to 198. Somewhere in there is what you should be paying for the company with a conservative price earning. This is really conservative, by the way. With a conservative price earnings ratio. Now, with revenue growths being also on the conservative side with Activision included, 196. So yeah, so maybe around to the $200 a share. That's where you're gonna get a fair price for Microsoft. So if you agree with me, then $200 a share essentially is what you're looking for this business. Ultimately, it's sitting at $327. That's quite the drop for it to fall. But if it does, you're getting this company at a decent price. Now, you may disagree with me and say, well, Leo, that's way too conservative. Why are you pricing this company so low? Because ultimately, I'm trying to give myself the biggest margin of safety as possible to make sure I don't overpay for this business. Now, I'll tell you right now, it's exciting to do the analysis at this point in the game because the fact that they just acquired this business. But like I said, I think in 1 to 2 quarters, I want to say half a year, when Activision's finally up and running in their ecosystem, it's definitely worth revisiting and trying to calculate it again. I just think currently where it stands now, if you were to buy it now, it's at $200 a share. Now, that being said, do I think Activision is going to add more to the business? Yes, and that price will potentially be higher. Do I think the price is going to go down to $200 a share in the next 6 months? I don't know. I don't have a crystal ball. However, as it stands, overvalued right now. Great business. I don't hate the business. I want to own it, but I want to own it at a fair price. That's the video. If you found it helpful, hit the like button, subscribe button, get the software if you want to analyze your own companies without waiting for me. I'll see you in the next one. Thank you so much for watching.